You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody, that music means it's time once again for the Advisor's Option, the program here on the old Options Insider Radio Network, where we break down the sometimes scary, impenetrable, opaque world of options for you, the busy financial advisor and asset manager who's perhaps looking to dip a toe into those waters. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If you're just listening to this show, first off, welcome. We like you guys, too. And secondly, there's a whole universe of other programs out there on our network, a full dozen for you guys to check out. So if you haven't done so already, make sure you head on over wherever you're listening to this. Could be iTunes, could be via our website, could be via whatever platform or app of your choosing. And make sure you grab the full network feed, get you the full dozen programs. Daily news show, volatility views, option block, trading tech talk, all that fun stuff. I guarantee you will not be wanting for options content. Of course, wherever you're listening, if you like the program, throw a few stars down there. It always helps with the search on those platforms, which can always be a little bit laborious for people trying to find the shows, quite frankly. iTunes and the others, even you think Google would have a handle on it by now, but when it comes to finding good podcasts in their own systems and directories, a little bit of a challenge. So help them out. Put some stars down there, and people will find it just like you. And, of course, however you listen, live or after the fact to our programming, make sure you hit us up. Questions, comments, insights. We do, yes, we do, like to hear from you guys, especially for this program, because we talk about such unique and interesting stuff here in such a niche of the option space that we do indeed always welcome your feedback, what you want us to talk about, some questions, and you guys send a lot of them, so keep them coming. And joining me on the old program today, let's go in order of a rotating arc around the east and then down through the Atlantic. Let's start all the way up. No, we're not going to Maine this time. We're going to one state over or so, to New Hampshire, where we are joined by Matt Ambertson, the founder and principal over there at ORATS, Options Research and Technology Services. Matt, welcome back to the show. It has been too long, sir.
Yes, it has, Mark. Good to be here.
Good to have you back, as always. And we'll keep that dial, that radius rotating down through the Atlantic I believe, I don't know, let's find out where they are. I believe we have the dynamic duo joining us from Swan. We have Chris Hausman, the portfolio and chief technical strategist over there at Swan, as well as Ash Vyas, the director of portfolio strategy and overlays. I know last time you guys were over there in Nassau, I believe. Are you guys, A, still there, and B, how are things at Swan these days?
Well, thanks for having us here, first of all. And we are currently still in Nassau, but we're definitely in the works to get back to Puerto Rico as soon as we can. And things are functioning as normal at Swan.
Glad to hear it. Glad to see something like a little bit of a displacement of the entire population of that area of the Atlantic hasn't slowed down things over there at Swan. And it certainly hasn't slowed down our shows. Let's get rolling right off with our first segment. Time for a little Tricks of the Trade.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, everybody, welcome to the Tricks of the Trade. As the man said, this is the portion of the program where we break down some of the things we like to do, maybe behind the scenes in our own portfolios or the way we look at options that could be useful to you. You know, the busy advisor and asset manager out there is looking to improve the way you deal with options and perhaps learn a few new tricks along the way. And, you know, one of the interesting topics, one of the questions we get a lot on this program goes along the area of idea generation, you know, strategy, you know, verification along those lines. People ask us all the time, you know, how do I know which strategy I really should be using? There is a legion, almost a limitless options menu out there when it comes to strategies, you know, iron condors, iron flies, simple covered calls. You can go as crazy and deep down the rabbit hole as you want. Obviously, on this program, we like to advocate for usually a simpler approach. Usually the KISS acronym tends to apply when it comes to options as well, but not every strategy works for every client and indeed for every advisor out there. So it becomes a question of how do you find and how do you identify which strategy is right for you? And Matt, I know you and your team over there, you have some background in this space. This is probably, I'm going to go out on a limb and guess, this is probably one of the questions you guys get a lot over there at ORATS as well. I imagine a lot of your clients come up to you and say, you know, I want to choose between a covered call on SPY or maybe some other strategy on Apple or something else in a commodity. You know, how do I pick from amongst all these three? So how do you, when people come to you with this kind of question, how do you usually start the conversation and what do you tell them?
Well, I'll back up a little bit. When my wife and I, or family for that matter, you know, make a big decision on, you know, a house or something or a vacation, you know, you have a few factors that go into, you know, the house or where you're going to go. And, you know, if you let each person put a weighting on that and kind of average the weighting, and then you could describe each house or each vacation under each one of those and just merely add it up, and you could, the better choice often comes out. I was up in Canada at the World Quant Canada conference, and Michael Mesher of Gammon Capital actually put this up on the screen, and I was very happy to see he called it the fitness function, which I didn't have a name for it, but I'm happy to steal it from him. And, you know, basically what we do it's a lot easier for people coming in and maybe options as a second language to describe their end goals, meaning, you know, what's more important to you: annual return, volatility, Sharpe ratio, Sortino, Sortino is the ratio that only looks at volatility on the upside, drawdowns, you know, how far things have gone from the high water mark, the length of the drawdown, and the win rate are a few that you can use as a weighting in your fitness function. And so once you start describing that to people looking at option strategies, the actual strategies and the profile of the strategies start to crystallize. And you realize that a person is describing an iron condor, or a person is describing a 1x2, or that, you know, how much do you value the market down 7%, down 15%. What do you want to protect? What do you want to get out of your investment objectives? And we found that this fitness function approach, where you interview the client, and then we literally have millions, maybe in the hundreds of millions of described back tests over 10 years that we can then kind of sift through and find the best characteristics that meet their fitness function, and begin to show them these are the types of strategies that might fit into the investment objectives that you're describing. So I don't know if I'd call that a trick or a great technique for working with people on various things, especially options trading. I think it really crystallizes and focuses them in on strategies that meet their investment objectives, Mark.
It's funny you mentioned that, because you're right. I've heard different approaches like this. I've never heard it all kind of lumped together, let alone given a name of the fitness functions. I kind of like that as well. So it makes sense when you think about this approach, from a 10,000 foot perspective, because people can get daunted, and advisors and asset managers can get daunted when a client comes in with these kind of questions. What is suitable for this person versus that? And you get the usual things that advisors like to do. How old are you? What is your risk tolerance? Okay, which is a ridiculous question to ask someone. What is your risk tolerance? I don't know, 7. It's a terrible. You can't really quantify that easily. You have to really dig into the weeds, and that's kind of what you're advocating here. If the advisor puts a little bit more time into this, starts, and these are all metrics that any given advisor should be familiar with. Sortino may be a bit of an extra bridge for them, but if they know Sharp, they should at least have heard of Sortino by now. So they should at least have a passing familiarity with that, and they could start getting these things. It actually is a quantifiable thing that you could do. You can take their, what you think their Sortino would be, and some of the importance. Maybe they're stressing, capital preservation. So you want to get towards the hedging side. Maybe they're stressing more of income and speculative. They want to get upside. They want capital appreciation. So you can start weighing things that way. Then it sounds like, Matt, maybe they could even call you guys up over there at ORATS, because like you said, you guys have the database already, and they could say, hey, I've got a client who's got a 6.5 here on this fitness function, and they're really weighing, the importance of hedging, for example. And I'm guessing you guys could run through your database and maybe make a few pointed suggestions for them.
Yeah, what we do is we give them a huge spreadsheet oftentimes, and it's very easy to put some formulas in, the worst month, how far was the worst month, and you could weight those. And then you could, the reason we give them a spreadsheet is then they could do formulas too, because, you get some of these data centric people, but then they come back and they're extremely happy. We do the heavy lifting, simulating trades over 10 years and, overlapping trades. So we don't have the path dependency. And then we give them this huge spreadsheet, that basically down the left-hand column has all these different strategies: Iron Condor, 20 delta, 10 delta, Iron Condor, 30 delta, 20 delta, and then all of the results that we have, including the statistics that we mentioned before. And then they could go ahead and try to find the ones that meet their investment objectives. But yeah, that's what we're doing, Mark.
Hey, Matt, it's Chris. I think congratulations on coining a new term here, OSL. So what I do want to say is, people that have portfolio managers or, people who've grown up in the equity side with traditional metrics such as Sharp and Sortino, when they start putting options into their portfolio, their risks start to change, right? And it may not be as intuitive to us who've been in this business for quite a while, putting in Greeks and all these different type of risks and how adding options can change your risk distribution, if you will, because at the end of the day, it's going to change the distribution of your returns. So something like the fitness function is perfect to try to bridge that gap between traditional equity portfolio risk measurements and option risk measurements. So that way, people have more options, if you will, and, explore different ways on adding incremental return to their overall portfolios.
Yeah, you're correct. I mean, they're used to, all these people are used to looking at a lot of the same stats that we look at. And so I think if you start with that, then it helps them get a quicker understanding And that's why, of course, we like the back test so they could see how certain strategies work under various scenarios. And like I said, getting it into their language really helps, Chris.
Speaking of language, I think this, we talk advisors here. That's obviously the target audience for this program. I'd imagine other platforms could utilize this approach as well. A lot of the retail brokers out there are always lamenting how do they get their clients to trade more? How do they trade more appropriately for them and their risk profile and what they want? So maybe an approach like this that's a little bit more quantitative may be the way to go for them. I know a lot of the firms are leery to put landing pages in front of people and fill out this and fill out that. But if you can get down to that quantitative approach, I know a few startups like Vest and other are trying to do this. Or I think Trade Legs had a similar approach as well, where they try to quantify what the person wants and then generate the ideal options trade for them. I think if some brokers could leverage that tech or develop their own, I think this has an interesting use case in that area as well for the clients, not just for the advisors out there. But an interesting discussion. You're right. It's a bit of a trick. It's a bit of a kind of I guess, melding of different approaches into one. But if you're daunted out there by this entire landscape, this entire universe of options, and you don't really know where to start, this may be a good approach for you. Start breaking down your needs and your clients' needs. Try to break it down to some sort of quantifiable factors, like we mentioned here, and then kind of dive in from there. And of course, if you got questions, I'm sure Matt and his team over there at ORATS, they have all the data, so they can point to you and say, oh, you have these numbers. Okay, you sound like you're an Iron Condor person. A little bit of an interesting approach, because that's one of the questions we get a lot is, how do I get started with this? And this may be an interesting way for you to go. Speaking of things that are interesting, it's time to break into the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to the buzz. This is, of course, a portion of the show where we tell you what's going on, all the hot developments, latest breaking news, and some interesting research as well coming out of the world of options that pertains to you, the busy advisor and asset manager out there. First off, let's kick things off on a bit of a high note. Earlier this year, there was a lot of hand-wringing, a lot of worry out there in the options world saying, we don't know where the volume's really going to come from, and most of the universe of options is contracting. We're seeing less than 20 names account for about half of the volume in the industry these days, and that arrow is pointing down further, not up. So that's not a bullish trend for the overall options universe and the options users out there. And of course, a lot of retail volume was flagging and big institutional volume was flagging. And it was particularly back at the big OIC conference a few months back that I know Ash and Matt, both of you attended, that were effectively, there was a lot of hand-wringing as to what is going on, what is going to happen. Where is this volume going to come from? Lo and behold, we're seeing the numbers out of our friends over there at OCC that October, at least, maybe turning that worm around a little bit. The numbers out for last month at OCC. They break it down across a variety of ways. Obviously, we're most interested in exchange-listed options, so we'll start there. That volume hitting 371 million contracts last month, a 20% jump from October of 2016. Even more interesting, a year-to-date ADV, average daily volume, up 3% from this time last year. A lot of people coming into this year were predicting another drawdown year in terms of overall volume. So seeing that year-to-date ADV up, that's a strong sign. Digging down the rabbit hole a little bit further, equity options volume up this month as well, 326 million contracts. That's a 17% increase from October of last year. Cleared ETF volume, ETF options volume, I should say, 126 million contracts, up 5% from October of last year. And index options volume, 44 million contracts, up a whopping 46% from this time last year. So it sounds like maybe those death knells were a little bit premature. I don't know, Matt, Ash, you guys are both at OIC. You guys heard the same hand-wringing and fear-mongering that I did. You probably left that conference with the same kind of gloom and doom perspective. It was a very gloomy thing this year. And yet, lo and behold, the numbers are they surprising to you, or did you guys expect this? Maybe, I don't know, maybe Matt, we'll start with you.
Well, I look at it on a macro picture. I don't know if you saw spot trading. They've cut their head count by 50%. They're heavily into that type of trading. And, so I'm wondering, I see volume, but I'm also looking at option market quality. And I know that was my biggest takeaway from OIC, and Henry Schwartz's presentation about all of the focus of the volume is in, kind of just a few stocks. And, seeing index option volume up so much, of course, with our research and my background is trading single stocks as a market maker. So I'm a little saddened by the numbers and even though we're seeing some growth here, I still am a little skeptical. I don't know how you feel, Anash.
Yeah, similarly, I mean, my takeaway from that conference was, wow, there's a lot of exchanges, but most of them aren't doing a lot. So I guess we'll see how that shakes out.
Yeah, there certainly is. There are no shortage of trading venues out there. I think we're up to close to 15 now or somewhere in that realm. So yeah, it seems like every year there's a new one or perhaps two added. And you're right, most of them just by definition can't all be 50% players. So you got a lot of sub 5% players floating around out there. And yeah, who knows? But yeah, and you're right. We haven't seen yet a solution to that concentration of liquidity. I'm with you. That's kind of probably my number one concern is getting that number back up over 20, maybe not closer to a healthier number like 50 or God forbid 100. That would be nice. But that said, it's going to take some time. But at least turning up the volume slide is a good start. Speaking of a good start, we're recording this right kind of in the teeth of earnings season. And we don't talk earnings a lot on this show because it's usually the domain of some of our other programs. But it's such a hot topic. People are hitting us up a lot about this, particularly now. It's a very, shall we say, volatile season with a lot of names, a lot of big names, the names that you and probably your clients out there like to trade or ask you to trade are performing, shall we say, very well. And the usual metric, the barometer we like to use in the options world for gauging earnings sentiment is going to be that straddle. It's going to be that at the money front month, typically a weekly straddle going right into the event itself, because we like that better than an earnings number or any sort of whisper, any sort of these other abstract metrics, because at the end of the day, the options number is showing you what actual money in the market is wagering. That's always a better indicator when it comes down to it. And so looking at a lot of these names, it comes down to how are they performing relative to what the market is pricing in terms of volatility, in terms of their at-the-money straddle. And at least this season, a lot of the big names have been outperforming. Chipotle, just a few weeks ago, they were pricing at about $20 or about a 6.25% move. They actually opened up down $41. So they were the first to really blow through their straddle by about 2x. And this is a very rare occasion to have big names outperforming so dramatically. Twitter, they were pricing at about $1.50. They moved over $4 in the after hours, so over 2x for them. Amazon, probably the most famous or infamous of the big names, they're pricing in about $40. They opened up the next day up over 80, so over 2x, and trading up over about 120 intraday. Since then, they moved even more. So you're talking almost 3x that straddle just in the intraday move. Google as well, pricing at about $40. They opened up the next day close to 80, or actually traded up intraday the next day close to 80. So again, almost 2x move there. Microsoft, traditionally a very staid name, one of the more reliable premium sells in the market for the better part of the last decade. The last year or so, that narrative has changed a bit. They were pricing in less than $2, $1.75, a little over 2%. They opened up $5.50. They traded up nearly $8 intraday. So you're talking over 4x on that straddle. So these are the outliers. People often wonder why we advocate against trading through the earnings event itself. Trading leading up to it, trading after it, that makes a lot of sense. Trading the event itself is always a bit of a crapshoot, and days like this, they kind of prove that. These are the outliers that, because a lot of people will approach us and say, oh, it's best to sell premium going into earnings. And a lot of times that's correct. You get that vol crush and it works out in your favor. But days like this, a lot of these actually happen on one day, one Thursday. So an announcement day like that a 4x move in a straddle, that's going to wipe out many quarters if you're trying to harvest. Let's say you're catching 50 to 75 cents every quarter on selling premium, and then you lose $8. It's going to wipe out years worth of profits out there. I don't know, Matt, this is an interesting debate we have a lot, and I kind of wanted to bring it up on this show, mostly because you guys do a lot of back testing, so you have a lot of data. It seems like the data we've seen is inconclusive at best. If you're going to actually trade through the event itself, and I'm sure a lot of advisors out there are getting this question from their clients, hey, should I trade options on Microsoft during the earnings or things like that? What does your data show you over there at ORATS as well? Is it pretty much a coin flip 50-50 that, short premium, long premium, you're going to win just about as much? Or do you have is there a different metric that you're seeing over there?
Well, we've recently added earnings to our new web-based back testing platform. So you could put in there, trade this many days before earnings and then exit this many days before or after earnings. So, and we're actually doing a huge test right now. So it's inconclusive right now, but I could tell you about this earnings. We have various, and by the way, every stock's earnings, like with, on average, is higher this particular one. So I would say that to start out with, that the stocks that you pointed out, the bigger names, are indicative of some of the smaller names. For example, the absolute percentage move the last quarter was 5.3. This one's 5.8. We have a forecast of an implied earnings move, and that's blowing out what our forecast is this year. So this particular quarter is a very big quarter. And then as far as making, kind of broad calls on earnings, it's awful difficult. I do have some clients that do quite well around earnings. They have some specific strategies that they implement. And it's quite interesting to, if you can imagine, if you look at the implied volatility going into earnings, it's going up. But how much should it go up? Some people track that and really look at any discrepancies. As a matter of fact, I have a Puerto Rican client that tracks that very closely and watches how the implied volatility usually tracks going into earnings and trades around that. Another client that I have that's successful plays the day, just after earnings, and to see if they could get the volatility to the right spot. We have a lot of metrics that take out earnings moves, both the implied earnings move from the option prices and implied volatility, but also the historical or statistical volatility taking out earnings moves. So we could look at where the volatility should be, and then also look at the implied earnings move. But yeah, for the most part, Mark, this been a big earnings, and it seems to what I've noticed is a big earnings season begets a big earnings season. Meaning, once you start seeing companies moving quite a bit, it tends to flow through the rest on average.
Yeah, there always is. I often joke on some of our shows like Volatility Views, even the option block, that there seems to be a narrative to every earnings cycle, and this one certainly seems to be, for the most part, buy premium, because you've done pretty well on a lion's share of the name. Not all of them, obviously, but for a lot of them, if you have to play, that was the way to play. Again, that's not always the case, but interesting stuff. I'm looking forward to seeing, Matt, when you guys crunch some more of your data, what you see, because a lot of the people I talk to on this subject, there hasn't been, surprisingly, there's not a lot of conclusive studies on this topic for as important as it is. And then B, what data there is usually pretty inconclusive. You sell premium, it works until it doesn't. A day like, that Thursday when you lose everything. And then, you buy premium, it's a death by 1,000 cuts. So either way, it's a challenge. But interesting stuff. Something to keep in mind, listeners, as your clients are approaching you asking, hey, should we be slinging some options here during the early earnings season? Easy for me to say. As Matt alluded to, trading leading up to the event could be great. Trading after the event could also be great. The event itself, a bit of a coin flip sometimes. So if you want to avoid that casino analogy that gets lumped around options a lot, that's when it actually is apt, because it's essentially a binary event. It's completely out of your control. Speaking of things that are kind of crazy and somewhat out of our control, Ash, you decided earnings wasn't a hot enough topic. You had to just dive into the hot topic of the day, which is volatility and market history in the age of Trump. And I don't know about you guys, but I can speak for myself, and I can also speak for pretty much the lion's share of everyone I've had on this network coming into this new administration. And we polled a lot of people, and I can't think of a single person that thought post-election day, post-inauguration day, that volatility would be lower. Everyone, to a person, assumed Trump equaled volatility. It was just the narrative. Everyone, it was accepted conventional wisdom. Trump, in his history, has never been a low vol kind of guy. He always tends to spark a lot of volatility. So I think if you had asked anyone coming into, and again, we did, coming into the inauguration, would you be buying VIX or selling VIX after that announcement? Everyone would have been buying. And we all would have lost our shirts. So Ash, break down your paper here. And by the way, I encourage all of our listeners here to check it out for themselves. There's a lot of great visuals here and a lot of great stuff that it's hard to convey in just a few minutes here on the show. So you can check it out over there on the Swan website. It's called Volatility in Market History in the Age of Trump. But Mr. Ash, break it down here. You did a lot of good analysis here on a topic that is, shall we say, somewhat incendiary these days.
Yeah, well, there's never a dull moment with the current administration. And, you're right. Like a lot of folks are trying to figure out, what's next. We certainly have a character in the White House, whatever your political views are. But this was kind of, our client-facing folks, would always get questions and stuff and, about some of the issues in front of us. And, at Swan, we don't actually believe in market timing. We believe we should always be invested and always hedged. And, we believe that's difficult to do over the long cycle market timing. But the next question is, well, why? And so, and then there's always but what about if the president leaves office earlier? What if we go to war with North Korea? Or what if stuff in Europe with populism and the EU breaks up? So we thought, it might make sense for a volatility and market history perspective, just to go back and say, look, we don't definitively know what's going to happen, and we can't predict anything. I think it was Niels Bohr who said, when it comes to prediction, especially about the future, it's really hard. And he was a Nobel laureate physicist, so if it's hard for him, it's probably really hard for the rest of us. But, just an idea of what did the market do and what did volatility do the last instance, in instances where presidents left office early, or the last 7 or 8 times the U.S. has gone into military conflict with a defined beginning and end, or, when you had some of the potential political upheaval that we're seeing, with populism in Europe. So, that was pretty much the focus of the paper, just trying to show, more of the outside view is more of a, probabilistic, regression-based, was there any precedent or baseline in these instances, just to give people some perspective of, it's really hard to predict the future, and market timing is very, very hard.
And what were some of the key takeaways from this paper? I know for me, just looking at this paper, one of my surprising things, because I knew this empirically, but when you see it visually, graphically laid out in front of you, it has a whole new meaning. One of my favorites is your graph here of just the 6-month realized vol of the S&P from 1928 till now. And when you look at that, you realize just how anemic, everyone talks about implied, but realizes the actual volatility we're seeing in the marketplace. You see how anemic we are in the 2.5 percentile right now. We're pretty much almost below just about every other data point on the chart there. So that gives you some perspective, listeners, of just how little volatility we're talking about right now. And again, if anyone had predicted this, then they're clearly great prognosticators, and also they're very wealthy right now because they made a lot of money. But that said, Ash, this chart is fascinating. You got a lot of other good ones here about global asset class volatility as percentiles here. You can see how vol is kind of just down across the board, but that brings up other talks about questions about correlation and things like that, as well as some of the driving factors of volatility. We've seen no shortage of macro events that should drive volatility in most scenarios. North Korea, you have a lot of domestic issues going on, and yet we haven't seen any of that materialize into volatility. What were some of the takeaways of your paper when it comes to those topics?
Yeah, well, some of them were very counterintuitive, right? People think about, generally uncertainty is not great for the market, right? And that was reflected in some of these situations. But if we kind of address the 3 basic scenarios that we looked at, one, the impact on U.S. markets of a U.S. president leaving office early, 2 instances when America goes to war, and 3, some of the stuff going on in Europe with populism, like things like Brexit, Trump, and some of these elections. Some of the findings are kind of counterintuitive, and you'd think starting with impeachment or presidents leaving early, there aren't a ton of instances where this has happened, and there's definitely a period of time of uncertainty where the market sells off. And I wouldn't necessarily just attribute it to this event because things like long-term capital or other things. It's hard for one driver to be identified as a sole catalyst in an open-ended system, But the data does tend to show that after a period of uncertainty, if you look at the Clinton impeachment and even Watergate, while there was a drawdown period, the markets recovered surprisingly quickly, especially in the Clinton, when Clinton went through an impeachment back in the late 90s. So, that's a little counterintuitive. Sometimes we have clients asking about, what should I do about this? What should I do about that? Well, if market precedent matters at all, impeachment is not necessarily a horrible thing for the market long term. It can often be a buying opportunity. Even more counterintuitive, and this has nothing to do with the costs in life and that sort of thing, but just from an investment perspective, you would think the uncertainty of war and armed conflict would be bad for the markets or volatility. It's actually, if you look at the past 7 or 8 instances going back to the 80s where the U.S. has gone to war with a defined opening and a defined ending period, and you look at what the market did in those periods and what volatility did in those periods, it's for most of us surprisingly counterintuitive to think that actually the markets went up and vol actually came in. No, there is a brief period of uncertainty where you kind of get, I guess the phrase these days is kind of a buy on the dip opportunity. But if you look at the precedent, generally the market's gone up in these scenarios. Now, a nuclear war is obviously, a deal breaker because we've never gone through anything like that, and hopefully we never do. But, if you can avoid that, it's actually been an opportunity from a market perspective. And finally, the thing about Europe, we've had this rise of populism on both sides of the pond, and there's just a lot of shots on goal. And the reason that we thought this was important just because of the scale, because you have all these countries in this economic union that doesn't have a political union. You're seeing kind of what I like to call kurtotic candidates on either side of the spectrum, like in Northern Europe from the right, in Southern Europe from the left. You've already had Britain leave. You've had votes that so far were for the status quo on the mainland, but it's kind of like a game of Russian roulette, is that there's so many of these votes coming up over the next 2 or 3 years. And the question is, how many more Frexit, whatever you want to call it, type things can the EU survive? And if it does, how does it impact the euro? How does that impact gold? How does it impact global volatility? I mean, the EU and these mechanisms were put in place after the world wars to make sure that people could agree to disagree in an orderly and peaceful fashion, right? So if there's a chance that goes away, I mean, that's a world that none of us, for the most part, have seen, at least not in our adult lifetimes.
Yeah, I think you can probably subtitle your paper here, unexpected outcomes or counterintuitive outcomes, because you're right. A lot of this paper, a lot of these conclusions are things that are contrary to popular opinion. You would assume that war would be bad, and yet the data there is kind of undeniable. The markets have rallied. You'd assume the impeachment or the specter of impeachment, or in the case of Clinton, the actual impeachment process would be devastating to the marketplace, and yet the market regained most of its losses within a few months. And even, getting back to that volatility point I made earlier, people would assume when realize volatility is so anemic, 3+%, that there's no opportunity for selling volatility. And yet, even at these levels with, realized vol around 3 to 4, VIX still at 9 or above, there's still a, 6+ or somewhere around the 6 neighborhood percentage point spread there. That is the risk premium that can be harvested and has been an effective trade throughout the year. So again, a lot of counterintuitive takeaways from this paper, Ash, but I think it's interesting. Again, worth reading. If you want to leave our audience any other kind of key takeaways from the paper, or maybe something else that surprised you as you were working on this, what was your last thoughts here, Ash?
Just a couple things, and you touched on them. Not only is U.S. equity vol low, but vol across asset classes is historically low, which I thought was kind of amazing to see that level of correlation. And the final thing is, most situations I think historically have been seen. I mean, it's always kind of risky to say it's different this time, but the one thing that we haven't seen is a unstable state with a nuclear weapon and the potential, which there are people with nuclear weapons are unstable, but a delivery mechanism, right? If you combine those two things, that's probably not something any president, who no matter who had won the past election, can tolerate, on his or her watch. So that's one of the few kind of uncharted things that I think this administration faces, and I guess we'll see how they deal with it.
Yeah, it's fascinating paper. Again, check it out over there on the Swan site there, listeners. And the title, again, is Volatility and Market History in the Age of Trump. I'll make sure we have time for some of our listeners here as well. We have a couple other topics we could squeeze in. Before we get to them, let's move on here to... Let's talk really quickly, because we're talking before about Sharpe and Sortino ratios and all of these. An interesting piece recently out of, I think it was Think Advisor. They were kind of talking about the rise and ultimately the fall of modern portfolio theory. It's something that a lot of people, myself included, we were all taught in college. This is the way to look at the market, the efficient market hypothesis, and diversifying across a number of different assets. Usually there's some specified number. It used to be 40, now it's 20 different assets is somehow the optimal amount of quote-unquote diversification that we're seeing. Of course, the Sharpe ratio, that gets into the early days before the precursor to things like Sortino and all that fun stuff. Then a bunch of developments happened over the years. We started seeing things like volatility being factored in, and people who are fans of efficient markets saying volatility is just noise. I think we all know kind of later on that it's not exactly the case. But it was interesting, I think, for us, particularly when it comes to our audience, these are people kind of lamenting now that they're seeing modern portfolio theory kind of in its death throes. And I would argue that for people in the option space, a lot of this stuff is pretty much already dead and gone and has been for some time because options are in many ways the kind of natural counterpoint to a lot of modern portfolio theory. Why should you go out and quote-unquote diversify yourself across 20 to 40 different asset classes in a portfolio, and then you are hedged when you could have the assets that you want and then hedge them using options? It's a natural, why go through that rigmarole, the hassle, the expense, and the effort when you could do it in a much more efficient and effective process? And of course, a lot of the other measures we talk about in options when it comes to volatility and things also kind of give a little bit of a counterpoint to these issues. So it is kind of funny to me seeing a lot of these people in the asset management world kind of wringing their hands, running around saying the sky is falling, modern portfolio theory is dead, we can't use this anymore, what will we rely upon going forward? When in reality, a lot of people in the options-oriented space have kind of known this for a long time and really have already been doing their own thing. And Matt, this probably resonates for you. You're a Sortino man. I'm sure you spent a lot of time in your early days studying things like Sharpe ratio and how these things worked, and probably like me, kind of shaking your head at why are we going through all this? We have an actual options market that can provide a lot of this already without all of the bells and whistles and hoops to jump through. So what are your thoughts on all this hand wringing that portfolio theory is dead? When are you in the same camp as me that if you're an options oriented manager or advisor, you're probably already doing a lot of this stuff and probably better?
And yeah, it's a very good point. And I alluded to my very long-term study, 180-year study of, and I think what's important when you look at even the survivor bias of the United States stock market, there was an interesting statistic that 75% of the time you're in a drawdown state, which is it seems. And if you think about it, okay, the market's going up in general, but over periods, you're down from that high water mark. Now, of course, we're going up, recently, but this is actually kind of a rare state that we're in. If you look at a longer history of 75 to 80% of the time you're in a drawdown state. And what I'm trying to do is, for my own portfolio and for my clients, is to look at what is the optimal way to protect a portfolio. And the problem with doing that, modern portfolio theory, has some input on this, but there aren't that many data points, and that's why I'm going back so far. And one of the things that we're finding is that these drawdowns, these large drawdowns, historically, even the Great Depression and before, look very similar in duration and the amount that the market has gone down. They look very similar across all time frames. So Yeah, I mean, options can give you that protection, and getting enough data points can give you some comfort in when you're designing these types of strategies to protect yourself, in these correlated times. So that's what I'm looking at, Mark.
I forgot about your massive eras spanning study. When are we going to see the results of that? Is that coming anytime soon?
I can't. It's a rabbit hole, and I just keep going deeper. But it's coming. You'll be the first to find out, Mark.
You're gonna get down to the Stone Age and what the price of flint and stone was back thousands of years ago. I like it. But yeah, that's a great little personal project. Let me know when you have some results from that. Chris, any thoughts here? Obviously, this is something that I think for a lot of the mainstream asset management financial advisor world is alarming, and people in the option space. Maybe not so much. What are your thoughts here?
Yeah, well, a lot of modern portfolio theory was developed prior to options as we know it today. So they didn't have this tool to hedge out their portfolios. And I think the financial crisis was a huge wake-up call for a lot of people that were adhering to modern portfolio theory, where a lot of assets went, their correlations quickly increased to 1, and that diversification that they thought they had wasn't really there. So what will happen in the future? Probably the same. I think if there is another type of financial crisis or a prolonged bear market, you're going to see correlations go back to 1, similar to what we saw back in the day. And I think you guys already know, we here at Swan just think there's a better way to do it. And that way is through options. And coming up with strategies that are time tested, and with the use of back testing tools, being able to come up with the right strategies for clients who have been basically who have not done well, or where modern portfolio theory has failed them when they really, really thought they needed it.
Speaking of needing things, we need some of our listeners to chime in. So without further ado, let's dive right on into our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. That music means it's time for you guys to take the reins. You guys send in a lot of questions. Try to get as many as we can. I've been promised you guys maybe an all question and answer episode. Maybe we'll do that because you guys write in so many. We do read them all. We try to respond as many as we can on the show, and the ones we don't get to, we try to respond in other ways. Let's start off with this one. This is a comment from my old buddy Don Slesher, my old co-host on Volatility Views back in the day, and he's never been known to pull punches on volatility-oriented topics, but he actually addresses an interesting one. I don't think we've ever really discussed it on this show, so it'd be interesting to get your pulse on this as well. He says, guys, if I ever live to be 100, I'll never ever understand utter gibberish such as the article below. All the technical analysis, pseudoscience, charting, etc., all to reach what conclusion? He's referring to an article. I won't name the article to avoid shaming them, but effectively it was an article about technical analysis and the VIX, and how using traditional and taking and applying traditional technical analysis techniques like your moving averages and Bollinger Band, all those kind of things, and applying them to a product like VIX, which, as we all know, is kind of a little bit of its own different beast. And let's see. I won't read the rest of his rhetoric. I don't want to get him or the person who wrote it upset or angry. But it's worth pointing out. It kind of leads to a good topic. We talked about VIX before on the show, just last episode. But some people have different approaches, and they try to approach it maybe perhaps the way they have traditionally approached other areas. And I'm not the biggest chartist. I think I had a lot of that beaten out of me on the floor of the SIBO when I tried to use it to scalp gamma effectively. I know, Matt, that was the start of your business there, scalping gamma using technical analysis. So we each had different experiences. Maybe we'll start with you on this front. What are your thoughts of taking, because you're probably the biggest chartist here, taking traditional technical analysis techniques and applying them to something like the VIX, which is, a derivative of a derivative and kind of a different beast?
Yeah, because technical analysis often points out some psychology and the psychology behind the market. And And then I think what your listener is pointing out is that, come on, guys, come on, tech guys. The psychology, a derivative of psychology. I mean, what is that? And I tend to agree that the VIX, trying to apply this normal technical analysis to it, but again, these data miners can find certain relationships, and it is at its core related to human psychology. So it does have some normal or repeatable patterns. An interesting tidbit, Mark, the volatility of Bitcoin is very close to the volatility of the VIX. So,
I see you've been reading Mr. Rhodes' his tweets.
I thought that was interesting.
I'm sure we'll discuss it on Volatility Views tomorrow. See, I've been trying to avoid Bitcoin. You just dragged me back into that phrase, sir. I can't avoid it. I'm like Al Pacino in The Godfather. I keep trying to get out, and they keep pulling me back in. But you're right. Bitcoin is it's volatile, but in terms of VIX, if people think it's low, it's not volatile. It has been moving. It's just moving to the downside for the most part, but it still counts as movement. I think people in the vol space only think of up as volatility. They don't think of down, and so it's a little bit of a different counterintuitive beast. Speaking of counterintuitive, Chris, any thoughts here on perhaps the counterintuitive concept of applying traditional technical analysis to something like the VIX?
Well, I'm going to have to defend technical analysis being a chartered market technician here. So I think when you're looking at the VIX was widely used back in the day as a indicator of short-term market bottoms, and it worked, pretty well. Then maybe today with all the different ETPs, ETNs, based on volatility, things have kind of changed. And then the response from a lot of people is, well, the VIX is broken. Well, the VIX isn't broken. It's still measuring exactly what it was intended to measure. It's just a matter of how you use it. Now, can you apply traditional technical analysis to VIX and trade volatility? You absolutely can. We do it here at Swan. So, don't poo-poo technical analysis 100%. Now, I think maybe the message is, will the VIX drive underlying movement? No, I mean, volatility is still an input into the model. I mean, you're not going to have volatility drive underlying. I'm still in the camp where underlying drives volatility, but I still think there are technical measures and indicators that you can apply to the VIX if you are trading volatility.
All right, since Matt brought it up, I have to ask you guys here on the show now. It's required by law. My hosting license would be revoked if I didn't do it. But we asked you guys this week. We like to ask questions of you guys as well. We asked you guys just recently. Bitcoin just last week blew past $100 billion in market cap, quote unquote. Take that for what you will. If now everyone's asking, are there options? No, there are not. But let's pretend. Let's pretend options existed right now. If they were available, what would you do? How would you trade them? Would you buy calls and call spreads? Would you buy puts or put spreads? Would you sell covered calls? Or are you in the other camp of I hate crypto? Now, this poll has just recently expired, so I have the results in front of me, so I won't vote. But let's go around the horn and see what you guys think. Maybe, Ash, we'll start with you. I'll drag you into the fray. You can blame Matt over there for invoking crypto. What do you think our audience voted for when it came to how they would use options on Bitcoin?
I would think they'd say buy calls or call spreads.
Interesting. Chris, are you of the same mindset, sir? Or are you more downside or dark side?
No, I am. I would buy calls on every 10% dip.
There you go. Feeling the love for some Bitcoin. Luckily for you, those 10% dips happen almost every other day, so you'd have a lot of opportunities to buy calls. Excuse me. Last but not least, Matt, you brought it up, so you get the final say here. What do you think our audience is doing?
Well, I know what I would be doing, and it's similar to what I did on the floor, and it would be buying premium and then scalping intraday. They have some pretty interesting tools to scalp intraday. There's a lot of inefficiencies out there. I'll have to give you my sad Bitcoin story. I speak at some of these events, the peaceful parenting, libertarian events, and I was introduced to Bitcoin when it was at 25, and they were saying, well, it's a little volatile, so I don't know if I'd invest in it. And then at 100, I was considering being a miner, but you're basically just paying the amount of money it costs to run the computers, the energy cost. And then now, I think it's headed to 10,000 before they decide, what to do with it. When CME and SIBO have it. So there's my my crypto story, Mark.
There you go. You could have had your own island the size of Puerto Rico if you had just been mining a few years ago. Isn't there a story out there that someone has a computer somewhere with 10,000 Bitcoins he mined way back in the day when they were a couple bucks, and now he threw it out in the dump and it's in the hard drive, so he's paying people to dig through this dump to find it because it's literally worth $50 to $100 million now. So a lot of sad stories out there just like that there, Matt. Let's see if we have time. See if we have a quick one here that we could squeeze in here. This is kind of a common debate. I don't know if we're going to settle it here today, but it's an interesting one. Matt, you probably have data on this. It might be a good one, actually, for you here. There's two related questions here. One comes from J-Dog. He says, I just got an options pitch that said options buyers lose money on 7 out of every 10 trades. Is that true? And then Alan Shepard, he has a related question. He says, why would I ever buy an option? He says when 90% of them expire worthless. But this brings up an interesting point. But this number is kind of like a moving goalpost. Everyone has their own axe to grind in this space. If you're a premium seller, you're gonna push that 90+% number. If you're someone else, I've seen different numbers out of the OCC. Matt, you have some data there actually on this. You got any thoughts here for J-Dog and Alan about your own percentage of how many options actually go out every month?
Well, this was the big refrain back in pre-87 is sell options until what they're not. This is a win rate, right? So if you were paid on just win rates alone, then this might be true. But the big thing to look at clearly is the big moves that happen once in a while make these ratios kind of a little bit meaningless. But and we all know that there is a volatility premium. I mean that you're paying for insurance. People are using options and paying up just a little bit in order for their portfolios, we hope, to be a little less volatile. So when you concentrate on just one of the, we started the show with fitness function. I mean, one of the fitness functions is the win rate, but the rest of it is, the long-term or expected, and what I call a debacle ratio. Are you protecting yourself? If the market does something crazy, as Ash pointed out. So it's more than just this one ratio, Mark.
Yeah, I think we just saw that outlined by the earnings numbers recently. That one day would have blown out a lot of these 90% and other days out there. So, yeah, I think take that with a grain of salt, listeners. These numbers get bandied about a lot, usually by premium sellers who are trying to advocate some sort of strategy for you. Take it all with a grain of salt. They win, they work until they don't, and when they don't, they tend to lose big. So keep that in mind as you're planning. Unfortunately, that music means we've come to the end of another epic journey through the advisor's option. What a journey it has been. We talked about Trump and impeachment and volatility and some counterintuitive conclusions of that. We talked about the fitness function and how you can use that to perhaps identify some strategies that you may want to use for your clients, how options volume may be a little bit surprising. Talked earnings, even got a little bit of Bitcoin in there at the end because it's kind of required by law these days. But before we go, I'll go back around the horn one more time. Let's start with Ash and Chris and the gang over there at Swan. By the way, listeners, if you want to check out Ash's paper, it's over there at swanglobalinvestments.com. Click around, you'll see all the different resources tabs there and the blog and all the other stuff they have there, and you could read the article for yourself. That said, Chris and Ash, what else is coming up in the land of Swan? You guys have any 10th boxes coming up?
Yeah, we sure do. We're going to start our 10th box seminars. And for those of you who are not familiar, the series of regional due diligence meetings, it's a good opportunity for advisors and investors to sit down with the portfolio managers and discuss the challenges in today's market and how the defined risk strategy can be part of their investment solution. We're going to start that up again here, first week of December. We'll be in New York and Boston, and you can get more information at 10thbox.com. That's 10thbox.com.
There you go, 10thbox.com to register for an event near you. And Matt, we talked about your upcoming massive foray into the research of all markets for all time. While we're waiting for that to come out, what can people find and expect from you guys over there at ORET?
Yeah, we're still very excited and adding more features to our online back testing. We just had someone sign up while we were talking. We're able to, test earnings as I talked about. We're able to put in your own technical dates to enter and exit a strategy, and then control the back test of options based on those dates. That's a really neat feature. We're also able to combine strategies, like you might combine an iron condor with an out-of-the-money put to finance your protection. So we're very excited. We're getting very good feedback from our online back testing platform, and that's basically what's new at ORATS. Mark?
And of course, last but not least, don't want to forget our friends over there, the Options Industry Council. Optionseducation.org is the place to go for all of their events, their webinars, doing an increasing number of those, as well as, of course, a lot of great resources for advisors. Click on over to that advisor tab, and you'll find it all there. You got to register, but it's worth it. A lot of great data over there for you guys to check out. And on behalf of Ash and Chris and Matt, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing, and of course, for sending in such great questions. And we'll see you next time for more of The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.